Good morning, traders and investors. My name is Roger Scott, and I'm still the senior strategist for Wealth Press. It's Thursday, it's February 16th. We only have 12 more days. We have less than 2 weeks till February. The second month of the year is over. The market action has been, to say the best. And I say, very, very gently. It's about 7:39. The market's going to open up in about an hour and 51 minutes to be specific with you. And today, oh boy, today we've got the PPI report. Now, we've got a lot of Fed data. I mean, let me just show you. We've got housing starts. We've got jobless claims. We've got Philadelphia manufacturing. And we have the PPI. And then Loretta Masters speaks too. I think overall, the big report today, the focus on everybody's mind is going to be the PPI and whether it's going to confirm or not confirm Tuesday's CPI. Now, Tuesday's CPI came... It didn't come out bad, but it didn't come out as good as everyone expected. And that's kind of in line with what the Fed has been saying. I mean, finally, they got to say the truth sometimes, right? I mean, even a broken clock is right twice a day. So the point is, we're waiting to see if the PPI confirms. In other words, and I'm concerned about year-over-year core, ex food and energy. I want to see this number clearly drop below 5.5, 4.9, 5.1. If it's 5.3 or 5.4 or 5.2 or even 5.1, it's going to say things are moving in the right direction, but not as fast as investors and traders want it to. So there's just so much more the Fed has to do. And with that said, the Fed has been doing everything possible to condition the economy for people to expect the Fed rates to go higher. And I'm telling you here, they're going to go to about 5.25%. Maybe 5.4. That's what I'm looking at to get to where they want to go, maybe even higher. But the PPI report is going to be the big report today. The other big report is going to be the housing start report. It'll be very interesting to see if builders are, in fact, if the numbers, if the starts and the permits are in line, because that's going to confirm that the economy is moving. Usually when there's fear of recession and interest rates are going higher, housing starts and permits are falling, but they've been holding on pretty well. Now, one of the downsides, and this is the unfortunate truth, one of the downsides of the economy being, like yesterday, we had retail sales yesterday. One of the downsides of retail sales being positive and jobless claims being low is the Fed can say, hey, not only is what we're doing working, but the economy can withstand higher rates because look, retail people are spending money, they're working, why not raise rates? It's better for the economy. Look, if the Fed could raise rates all the time, it would make their job easy, right? So the point here is don't be surprised if the market softens up on good news, because the better the news and the more surprising the news is, the more ammunition it gives the Fed to continue doing what they've been doing, okay? So that's one of the reasons why the market was kind of yesterday. It wasn't really all that great in line of what we saw. But so far, the Fed data hasn't been bad. It's been actually meaningful. Now, looking at the bond market, as I explained to you, this rally isn't going anywhere. And this right here is negative for stocks. This is not good for stocks. Nothing good happens when stocks do this. So when the bond market's going down, interest rates are going higher. When interest rates are going higher, it's putting pressure on right here, the QQQ. Now you see this right here? I want to show you something interesting. Now tomorrow we'll talk about algos, but you see right here how it breaks out? Look at the SPY. Oops, wrong symbol. I wanted to show you this. Double whammy. Look at that. Look at the SPY. Notice it doesn't do that. It went right to the top, but it didn't break. That's what the algos do. They break, they make it look like we're going higher, they break us out, and then they pull us back in. Exactly what happened right here. This is the most perfect example of it. This is a perfect example of it. They go outside of the range, they take us out, and then they bring us back in. That's exactly what they're doing right here. But notice on the QQQ, on the SPY is much bigger than the QQQ. They weren't able to get that much out of it. But on the QQQ, they took us for a ride. Look at that. And I'll bet you a nickel, Bunch of people bought right here. They had buy stops right here, and they bought, and let's see what happens if this puts us right back into this trend. But that's the kind of stuff we've been seeing. That's the kind of shenanigans and monkey business we've been seeing out of the algos lately. So let's see if we get some follow through today, or if the market cools off. Because based on momentum levels, which I'll talk about, the market needs to cool off. It's too much upside too fast. It needs to have a little more range-bound movement, like the Dow. So 3 U.S. benchmark indices closed higher in a very choppy Wednesday as investors continue to speculate about the future of the Federal Reserve interest rate policy following a stronger than expected retail sales report. And again, stronger than expected retail sales report gives Fed ammunition. The Commerce Department showed that retail sales went up 3% in January, which unbelievable, rebounding from a decline of 1.1% in December, driven by purchases of motor vehicles and other items. Now, economists had anticipated an increase of 1.8%. They got 3%. They anticipated 1.8, they got 3%. The blowout retail report offered evidence of a resilience, bolstering expectations that the Federal Reserve will push the benchmark rate above 5% by midsummer. Do you see that? I'm not the only one. So a lot of this positive data, it's really good for us in the long term, but in the short term, ouch. On the earnings front, ADI, one of my favorite chip companies, I love this company, closed up 7%. They had better than reported news. Cisco soared, which is great. One of the reasons we had that upside in technology yesterday. Shopify did not. And Shopify is more like Amazon. It's a lot of the this consumer discretionary. Because remember, Shopify, they put carts, shopping carts on your site so you could sell stuff. So less people selling stuff online equals less money for Shopify. I want you guys to understand that. I mean, it is a tech company, but it's more of a tech company that's designed for consumer discretionary. And that's why I say it's very, very hard these days, especially as we get into technology gets more advanced, to separate technology from consumer discretionary. Is Amazon technology or consumer discretionary? Is Apple technology or consumer discretionary? I mean, you tell my daughter that iPad is technology, she'll tell you it's consumer discretionary. You know what I'm saying? So again, it's all, and then you got the communications. They're all related, which has 2/3 of FANG in it. Anyways, today we've got Applied Materials, another chip stock. Hasbro, the beaten down toy company. DoorDash, my wife and my daughter's favorite company, and Dropbox, something I've used for years. All eyes today on the PPI. It's coming out in, let's see when it's coming out. It's coming out in about 45 minutes, 44 minutes. And again, we're looking at the PPI to be at 5.4 compared to previous values of negative 0.4 for the month and 6.2 year over year. So if we go up here and we go to PI, sorry, just want to be as thorough as possible with you. This is what we're looking at. I would love to see the number at 5%, 4.9, 5%. I'll even take 5.1. But anything above 5.1, it's going to be squirrely. So be very, 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 very careful on that. Now, in terms of earnings, we have today Crocs. Crocs, one of my favorite retailers, is coming out. And I mentioned we have Applied Materials. Crocs is expecting 60% revenue growth year over year. Remember I told you this company is doing something right? 60% revenue growth. Can you imagine in this economy, 939 million in revenue, 60.1%, and earnings up only 5%. But hey, if revenue in this economy is moving, I'll take it. You've got one of the biggest gold stocks coming out today. You've got ED coming out. You've got Datadog coming out. So you've got the mid caps and smaller stocks starting to make their move. So we'll have to keep an eye on that. Tomorrow, you don't have a lot of stocks coming out. You've got AutoNation, Barnes, but the big, after today, the flow of earnings comes down, and then we have less than 20% left. So this really is the week. Now, I wanted to show you something. Looking at volatility, it still has not moved up at all. And I'm expecting volatility to start moving higher. See how choppy volatility is? The volatility is taking on this volatility right here. Is doing this. Let me just delete this line here. It's doing this for the same reason that the Dow Jones is doing this. This is the broad market, and this is what the Dow Jones is doing. So we may be in this pattern for a while, and what I'm afraid of, because the technology is a little stronger, but not that much stronger, we're going to end up seeing the same type of movement, more or less, in the SPY. See this consolidation? I think we may consolidate and just kind of consolidate. But the fact that we're breaking out in the QQQ really worries me. And because we're so choppy in the Dow, I'm just not seeing a major breakout to the upside. And that's one of the reasons why I think we're going to cool off. And also, the bond market has not been cooperating with us, and yield has been higher. Most importantly, as I've mentioned to everybody, and I've mentioned this many, many times, look at the stocks that are the most speculative. Consumer discretionary, 88%. Look at consumer staples, 27%. Look at that stark difference. This should be at 27%, and this should be at 88%. Look at utilities, another defensive sector, and look at communication services, 80% versus 60%, 20% versus 33%. So the numbers are much bigger. So what I'm expecting to see is these reds go back into green, and these come off back into the 50th percentile. Now, as far as the Dow Jones, only 57% of stocks are trading above the 50-day moving average, and 66 are trading above the 200-day moving average. So there's just not that much upside right now. We're in a choppy market. It's great for swing trading strategies, but it's awful for trending strategies. Now, let's go to Stock Fetcher, where I'll talk about ETFs. We've got ETFs. So let's see what's strong, what's not, what's leading, and what's lagging. So communication services, technology, still haven't given up the ghost. Financial and industrial. Let's look at the chart. Communication services looks like it's starting to get really choppy here. I don't think it's going to go higher. I think it's going to just chop up. I still like technology, but I'm very... see this chop? This is what I'm talking about. We may stay in this chop. We may stay in this chop. We may stay in this chop. That's the problem I am seeing right now. Consumer discretionary actually looks pretty good, but again, I would be very cautious right now. I would be very cautious right now. If anything, maybe financial, maybe industrial, and maybe financial. That would be the only real thing I would consider taking directional bias in. I would want to see some more confirmation of upside in technology, or I would want stocks that are really moving and have completely ignored this. But you got to be really careful right now. In terms of strength, as I mentioned to you, financial and industrial are your best bets right now. And let me give you an option on the financials. Oops, sorry. Yeah, financials are still giving us a little upside. So what I would do is I would go out about 65 days. You have historic volatility implied is okay. Option liquidity is not an issue. It's $36 right now. Look at this. You can get a 37 call for like $1, or a 36 call for $1.70, and the spreads are like 5 cents. So these are great options. 36, 37 strike price, $160, $170. Don't miss out on that. Now, before I let you all go, folks, all the inflation data we've seen this week, it has the power to really move the markets. That's why I'm holding a very special live training session at 1 p.m. Eastern time today. And I'm going to cover market action and my number one way to capitalize on it. I'll even reveal my top 3 high alpha stocks. That's right. Click the link. Click the link, and if you're in the Wealth Press YouTube channel, follow the link. It's underneath the video. And if you're on the Wealth Press page, you could see it below the video. Join my Telegram channel too, and get direct access to my event at 1 p.m. And I want you to be on my Telegram channel because I send pictures of my cats. I send pictures of my family. I send trade alerts there. Notice I sent pictures of my family and pets before I set trade alerts. But join my Telegram channel. The link is below here, and you'll get a bunch of goodies, and you'll be the first ones to get the alert. I personally send them out with every trade. Follow the link, send me some feedback, and I want to hear comments from you, and I will respond. You can also send me an email at support@marketgeeks.com. Like and subscribe to my channel, and I'll talk to you soon. Bye, guys. Have a great Thursday.